The prospect of higher interest rates sooner rather than later is now real, with annual inflation in the US again above 5%. Our business editor Ross Greenwood joins us now. Ross, the Reserve Bank here says rates still won't move until 2024, but is the RBA going to have to move on that?
It may very well have to after inflation came out again higher in the United States overnight. And now the Federal Reserve, its equivalent of the Reserve Bank, having to make some hard decisions about when interest rates might move up over there. Of course, they've also got to take away the so-called quantitative easing or money printing. That'll be tapered out. Then eventually the hard decision will be whether they do the same thing that the New Zealand Reserve Bank did last week and actually raise interest rates. So overnight, if you look at the inflation numbers, they put out monthly inflation numbers. You can see here it was 0.4%, which was up 0.1 from 0.3% in the previous month. But it's that annual inflation there, and that is 5.4%. Now, it's a range of things. It's food prices, it's the cost of transport, it's the cost of energy right around the place. And this is a reason why economists right now are suggesting the Federal Reserve will have to move. This is Sam Risciuto, an economist in the United States overnight.
Well, the Fed is doing what the Fed always does, which is basically taking the movements in inflation on board and looking to make sure they do not get entrenched in the system. And this is the reason why the market is anticipating Fed rate hikes coming shortly after the Fed is completed with its quantitative tapering. Which they believe will probably be done by the middle of next year. And that's why the markets are already pricing in a potential rate hike in September.
Ross, the oil price must be fueling this, with prices continuing to rise.
Well, that's the case also. Now, remember that, oil prices at one stage were down in the 30s, $30 US a barrel. At that time also, you had coal prices at very, very low, record low prices. But what's happened is as supply chains have picked up, as economies have recovered, these prices have risen dramatically. So here's the oil price from overnight, $80.71 US a barrel, up by another 27 cents. The other aspect of this is, of course, you're seeing it with fuel prices here, just the price of petrol around that you might be paying, but that's feeding into supply chains. Now, the central banks around the world have got a big decision right now, and that is, do they, as the Reserve Bank is doing, saying, look, this inflation is not going to stay, it's transitory, we'll look through it, and therefore we'll keep our interest rates low until 2024, because what you do not want to do is have the inflation baked into your community, because if that's the case, then interest rates will rise quickly, which has consequential impacts on asset prices. We're thinking house prices there, thinking share prices. At the moment, the share markets are not really, they're believing the central banks that it's transitory. But the interesting thing is if it becomes baked in, then you've got some bigger issues.
The RBA must also be weighing up what the coalition is weighing up at the moment, and this is net zero. So there's an important speech by Guy Debelle today, and we're in this situation where we've got plentiful coal and gas, but it might be devalued by some parts of the world as they pursue net zero, but countries like China still have an insatiable appetite for it. So how does this all feed in? And if we're following the money, what are we seeing?
Well, it's a conundrum, isn't it? Because you're quite right. You've got coal prices right now at record levels, and yet the very thing that we want to stop mining, according to the net zero agenda, is the stuff that's at record prices right now and in demand from China. So the point is, if you're not burning it here, it still may be burnt in China at those record prices, because China, like Australia, doesn't want the lights to go off. Guy Debelle's speech today, the Deputy Governor of the Reserve Bank, is all about the asset prices and financial stability. In other words, if all of a sudden you take out coal, you take out, say, for example, gas, what do the asset prices look like then of the companies, not only that own them, but the companies that have financed them? We're talking here the banks, we're talking big insurance companies. And so this is about trying to understand how financial stability looks in a carbon zero future. And of course, it means that central banks, like the Reserve Bank here, have also got a plan for those things.
Yeah, OK. So can I ask you this as well about that then? Because if you're looking at the finances of all of this, he also says in this speech that whether we like it or not, the world is moving towards net zero. So what does that mean? I mean, how does Australia weigh up signing on to these targets so we attract international investment as well? Is that a big part of this puzzle?
Oh, no doubt, because if you're talking of net zero at 2030, 2040, 2050, then quite clearly you've got different time horizons on which you are going to phase out some of these commodities, and therefore you've got time to be able to write them off. Now, it's interesting to note, just in the past year, with LNG prices collapsing in Australia, which have now obviously soared as a consequence of China needing the energy, there was about $25 billion written off the value of Australian assets in LNG just in the past year. Now, they're going to have to write them up, you'd have to imagine, but long term, I suspect they won't write those assets up when prices rise, mainly because they will understand long term, if they deplete these assets, or indeed if you go to a carbon zero future, then ultimately the value of the assets will be zero if the world doesn't need those commodities anymore.
Yeah, very interesting indeed, and this is why there has been no agreement really for the last 2 decades. But anyway, let's look at the unemployment rate. They're now at 10-year lows. Will it stay there?
So, all right, so 10-year lows right now. And remember, that's because of the participation rate. With lockdowns, a lot of people simply withdrew themselves from the workforce. As a result, they're not counted. And so the unemployment rate, surprisingly, has been going down, not rising, as people have been out of work. Now, the forecast, and it's in about an hour's time we'll find this out, is at 4.8%, which is about 0.3% higher than it was the last time around. The forecast is also 110,000 jobs have been lost. Can I tell you also that these forecasts have been monumentally wrong for the past 3 or 4 months, simply because of that participation rate. So we'll know in an hour's time whether the economists have got these forecasts a little better this time around, or indeed whether more people have dropped out of the workforce as a result of lockdowns and the unemployment rate continues to fall.
Okay, somehow I think it can only get better, but we'll see. Ross Greenwood, great to chat to you. We'll see you soon.
No problems, Laura.